On at 8:30. We need a roll call, Judy.
Mr. Land?
Here.
Mr. Kelly?
Here.
Ms. Cavanis?
Here.
Mr. Jurdy?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker? Absent. Ms. Harris?
Here.
Mr. Swope?
Here.
Ms. Pierce?
Here.
Thank you.
Okay, Trustee Pierce, would you like to lead us in the Pledge of Allegiance? To the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Is there any public comment? Seeing none, we'll proceed to the swearing in of Leonard Swope. And Judy, are you going to help with that?
Give me just one moment, please.
Okay.
Of the state of California against all enemies, foreign and domestic, that I will bear true faith and allegiance to the Constitution of the United States and the Constitution of the state of California, that I take this obligation freely without any mental reservation or purpose of evasion, that I will faithfully discharge the duties upon which I'm about to enter. I hereby attest that as a member of the Mendocino County Employees Retirement Association Board of Retirement, I will carry out my duties and responsibilities with respect to the Mendocino County Employees Retirement Association in accordance with the highest fiduciary standards and in compliance with the laws, regulations, and policies applicable to the Mendocino County Employees Retirement Association.
I do.
Welcome, Trustee Swope.
Thank you.
Next, we have the consent agenda, the minutes, the retirement report, preliminary monthly financial report, quarterly member direct usage, and an annual trust and education training report. This is one action a consent agenda, and would anyone like to make a motion to approve?
I move approval of consent. Second.
So moved. Okay. Moving on.
Comment?
What?
Can I have a comment?
Of course.
Okay.
I'm sorry.
Yeah, thank you. So on the monthly financial report, I appreciate the fact that our net position has increased to $690 million.
Ooh.
And getting back up to that $700 million mark. And I just wanted to make an observation that our annual outflows in beneficiaries in excess of cash flows in, which is the money paid in by the employers and the employees, is roughly $8 million a year. And at $690 million, that $8 million a year outflow out of the plan is only just over 1%, 1.2% of the total fund. I'm not an expert on endowments, which endowments are forever funds that will never, they're planned to never run out of money, but my understanding is that endowments look at a net cash, they can sustain a net cash flow of out of 2.5 to 3.5%. And so we're well above that, which we want to be because we want to build to be a 100% fully funded plan going from roughly 70% to 100%. So this is how we're getting there. But I just wanted to point out it's actually a very tiny amount that's net flow out of the plan. And one of the things I'm hoping we're going to do is as we look at our portfolio and if we went to some less expensive investment funds, we could drop that net flow out of $8 million a year to about $7, which would further reduce the percentage and make it that much easier to have that outflow out. So anyway, just thought I think it's interesting that as we get towards that $700 million mark, just to realize how little has to come out of the plan to sustain the plan, because we should be able to build up the plan to 100% funded with such a tiny amount coming out of the plan.
Well, thank you very much, Trustee Jardy. That's a nice, positive information. Okay. Next, all in favor?
Aye.
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 Aye. Okay, motion passes. Next on the agenda, we're going to the historical benefit review, project status report, and project updates.
Thank you, Chair Cavness. The report this month, as I mentioned last month, just has a few cleanup items. These actions that are reported for January 2024 were actually all corrections or items that were done earlier but had missed being reported in the period in which they were occurred. So if you have any questions regarding the benefit project, I'm happy to answer any questions. Thank you.
Okay, seeing none, we can move on to item 4, discussion and possible action regarding investment matters. Okay. Is there any public comment on the historical benefit review project?
There is no public comment.
Okay. Then we'll go on to item 4, discussion and possible action regarding investment matters, capital market expectations, education. And who do I?
Trustees, we've got Callan here today, John Perone and Greg DeForest. They're going to talk about, looks like they're on mute. Here we go.
Oh, my bad. I think I hit mute accidentally. Sorry about that. It's so great to see you all. Today we have a informational educational session to share with you to talk about capital market expectations. And we do this annually where Callan updates our capital market expectations and we share with you what we say your long-term expected return should be. Now, keep in mind, our numbers are just a little bit different from the actuaries' numbers. They have a different time horizon, and they could have different inflation expectations as well. But you'll see that they may not match 100%, but they certainly rhyme with each other. And what we want to do is make sure that we're in a position to be successful over the long run if we maintain that spending and contribution policy that was talked about just a few minutes ago. If we keep that over the long run, will we be successful? So we'll hop into this, and John Perone, who's a member of our capital market research group, will lead that discussion. I'll share my screen in just a second. Before we get into that, I did want to provide a quick update on the equity manager searches that you asked us to perform. So, as you might recall, we were taking a look at the small and mid-cap managers in the domestic equity portfolio. And the decision was made to take a look and see, well, if we changed anything, what would it look like? So we're taking a look at what you call SMID-cap managers, and we're looking at them in 3 different categories: SMID-cap growth, SMID-cap core, and SMID-cap value. And we are about halfway through the due diligence process on that project. Robert was kind enough to drive down and visited us in our San Francisco office here last week. And we went through the first cut of all of the managers to come up with a broad list of 10 to 12 products in each of those 3 categories. And then next week, Robert's going to come down again, and we're going to talk about and walk through a due diligence report for all of those 30 or so managers. So that's where we are at with that one project. Okay.
A quick question on that.
Yeah.
So I don't know the companies or the funds that you're looking at, but there's a highly regarded small cap value fund called the Advantis Small Cap Value Fund, AVUVX. Only 25 basis points, and it's rated silver by Morningstar. Probably be rated gold if it was a longer lasting fund. It's relatively new, started in 2019. So I personally want to see how that fund compares with any of the other funds that you bring forward, because it's performed pretty well. It's got a pretty good cash flow, very low PE ratio. Anyway, it looks like it's performing really well, even though it's only existed since 2019.
Oh, okay. And Dan, what's the ticker on that again?
If you want to look at the institutional, well, I'm not sure about the institutional one. I think the institutional is AVUVX, 25 basis points.
We'll take a look and let you know either where it fell out in the process, or include it if it's a good candidate. We're really focused on SMID cap strategies. So if it's a small cap product, we might just have to take a look and see how that fits with the mandate that we've been given to look for. But we'll take a look at that.
And one question, Greg. So is it Callan's belief that that small and mid as a group, the whole basket of small and mid, that they're outperforming the S&P 500? I mean, they've been lagging in recent years. So
yeah, it's been a decade since they've beaten the large cap.
Yeah.
Market.
So what's the goal with this? Finding the SMID, whether it's small cap, mid cap, or a SMID, is it to outperform the S&P 500, or is it to just mirror the small and mid?
So all of these funds and strategies that we're looking at, they'll have a benchmark that they are supposed to beat. So they will be benchmarked to a small and mid cap index, as opposed to the S&P 500. So that's kind of the way institutional managers operate. They're given, a benchmark to beat, and they're given a area to operate within. And if they deviated from that area, we would actually be upset. We would say they're not sticking to their style, or they're adding on risk that we didn't ask them to add on relative to their index. So all of them are there to beat their small or mid cap index. Now, you might ask the broader question, well, why do we have that if it's not going to beat the S&P 500? And for the past several years, it's been really hard to keep up with the S&P 500 because it's been extraordinarily concentrated and largely driven by about 7 stocks. And when we have seen this in the past, that is not sustainable, right? it will likely revert. And we don't know when or how much, but we don't want all of our eggs in that one basket, especially that one basket that has done so well for that amount of time. So the small and mid cap brings us diversification. But over the long run, it should also bring us a risk premium. There should be a risk premium in investing in small cap relative to large cap over the long run.
Madam Chair, if I can.
Yes, go ahead.
Greg, remind me and the other members here in attendance, the direction to Callan was to bring back information on SMID so we can make an informed decision if we want to go that direction, but that has not been decided yet. We're going to get the review of the SMID cap performance and then decide if we're going to stay with the current asset allocation or change it. Is that correct?
That's correct.
Thank you.
Okay, let me, 1 second, I'm gonna pull up my screen here. There we go. Okay. Wonderful. Okay, I'm gonna hand it over to John now, who's gonna walk through our capital market expectations.
Yeah, thanks, Greg. Yeah, if we go to the next slide, just kind of give you a little tour of where we're going to go over the next half hour or so. That just to start with some introductory remarks in terms of why are we making these capital market assumptions, and then we're going to take a look at current market conditions. Look at the economy. I think we all recognize the economy is surprised on the upside for 2023. We'll talk about some reasons for that. And then we'll kind of get into the meat of the exercise, which is looking at capital market assumptions for 2024. You'll see there's some revisions, and we'll walk through kind of the logic behind those revisions. And then kind of the dessert, or whatever, if you will, is taking these capital market assumptions and applying them to your current asset allocation. So we'll take a look at what your current based off Callan's projections are for expected return and risk. And just kind of a spoiler alert, if you will, that the news is good, that that based off our current projections, we project over the next 10 years that your plan will outperform its bogey being the discount rate of 6.5%. So that's where we're gonna go. So let's kick off, and just some quick introductory remarks here on the process overview. What are we doing here? Okay. And so what we're doing here in terms of these projections, we're not trying to say what the market's going to do over the next 3 months, 6 months. Okay. We're looking at it over a strategic planning horizon. So we're looking at what do we think are reasonable expected returns for your asset classes in your portfolio over the next decade. Okay. And we're going to go into a bit of detail for some of the key asset classes in your portfolio. So for example, equities, right? That's really the primary workhorse at the end of the day in terms of what's going to be conferring that return to your portfolio, again, to ultimately seek to outperform that 6.5% discount rate, right? So you've got equities. Another key piece in your portfolio is obviously the bonds, right? The bonds have a more defensive aspect to the portfolio. They diversify the equities. They reduce the risk of the portfolio. And then obviously you have the alternatives in your portfolio as well, composed of both the private real estate allocation and the infrastructure allocation. And again, the point of those assets is to confer growth as well, right? To try to seek to grow the portfolio over time, but do it in a manner which diversifies that other kind of primary growth engine in your portfolio, which is the equities. Okay, so when we develop these capital market assumptions, yeah, we like I said, we have models for each of these asset classes, and again, we'll touch on kind of the key points as we go through. It's also important to be cognizant of the economic environment, right? So we have models for what we think inflation is going to do over the next decade, interest rates. But at the end of the day, that there's a fundamental belief, and this is kind of linked back to what Greg was saying earlier, that risk is going to be rewarded over a strategic planning horizon, right? So investing in equity markets, we expect will outperform bond markets over time. And so you will see that play out as we kind of go through the numbers. So the next slide, again, this is a quick teaser. We're going to go through the detail here in a minute, but these are what Cal's projections are for the next 10 years, right? So let's focus on that expected return number. Okay, so think of this as the annualized return over the next 10 years for the different asset classes in your portfolio. And so you can see equities, we're projecting a little bit above 7.5% a year. And again, you have kind of two different flavors in your portfolio in terms of domestic equities and international equities. We're projecting similar expected returns for both those. And again, we'll get into some of the reasons for that downstream. The real key thing is that in terms of what's changed today from a couple of years ago is that, as you all know, interest rates have materially increased, right? And so obviously there's some pain while interest rates increase in terms of your bond portfolio taking a hit, but ultimately it's good news at the end of the day because now yields are materially higher for fixed income than they were in the past, right? So you see how our fixed income projection is north of 5%. You know, if we were to roll back the clock and look 2 years ago, 2022, we were projecting less than 2% for bonds, right? So now that ballast in your portfolio, the fixed income, now it's not just finding a defensive aspect of the portfolio, it's actually starting to contribute to the expected return of the portfolio, right? You see that kind of flagged in the first bullet point there. We're now at the highest expected returns for fixed income since the global financial crisis back in 2008, right? Now, and so what's interesting is that if you look at kind of the gap between, like, what is the difference between equity returns and fixed income returns? So our equity returns are slightly higher than what were last year, pretty similar. So that kind of gap between here's equity up here, here's fixed income. Now that gap is actually, and I'll show you a slide there on kind of depicts this, but in terms of our projections, it's the narrowest spread that we've seen in 15 years between stocks and bonds. Okay, so again, kind of quick teaser. Now let's kind of back up and examine some of the reasons for the projections. So let's talk about the current market conditions. And as I mentioned at the top, right, you know, if we were to do this talk 12 months ago, what was top of mind for everybody? Recession, right? And the only real argument, if you talk to market pundits, was it going to be in Q2? Is it going to be in Q3? Right? And lo and behold, I have to confess, we all got shocked by what happened, or surprised, if you will, what happened in 2023, right? So, I mean, if you look at the GDP growth, it was pushing 5% for Q3, right? And then 2% plus at the start of the year. And if you look at kind of market projections for what Q4 GDP is looking on the order of 2.5%. So quite robust. And think about all the things that's the backdrop here, right? We've got market increase of interest rates, obviously geopolitical tensions, you know, against that backdrop of higher inflation, right? So, so why did that happen? I mean, I would argue it's really been from robust consumption by the U.S. consumer at the end of the day, right? That if you all saw the news this morning, right, the consumer spending for December that was at well above expectations. And if you think about what wage growth has been for the consumer over 2023, you know, it's like 4.1%. So consumers' wages have been increasing. You could also argue too that there's you think about the huge fiscal stimulus that came out over COVID, you know, that's being worked off, but that's still been another tailwind to the economy, right? So again, recession, the start of the year, we look now, it sure looks like there's a decent chance we're going to have a soft landing, right? But of course, we still have risk on the table. The kind of second section, right, that we've had a huge increase in interest rates, right? A generational interest increase, if you will, over 5% increase. And so inflation's and so what's the point of increasing the interest rates? Again, we're trying to control inflation in the economy, and inflation has gone down, right, from that 9% we had in the summer of 22. If we look at inflation now, we're looking kind of 3.5%, if you will. And what's really happened is that the Fed has pivoted, right? That the Fed the Fed expectations were the interest rates were to be high for the foreseeable future, right? And so in Q4, what the Fed did is actually say, hey, they actually signal modest interest rate decreases for the coming year, okay? Now, in terms of primary risks, again, I think what we would say is if you look at that second bullet at the bottom there, it's kind of a last mile problem, if you will, in terms of inflation, right? So yeah, we've gone a long way, gone from 9 to let's call it 3 and change, but the Fed stated goals is 2%, and going that last percent is what could really cause strain to the economy, right? Because the only way you can kind of get down there is to have a period of below trend growth. Again, we talked earlier how that 23 was a year of above or above trend growth, if anything. And so that's kind of the main risk on the table, if you will. Let me pause there because I kind of threw a lot at you in short order. That any kind of comments or observations on economic conditions? Okay, so that was kind of the economic backdrop for 23, and as we know, equity markets end up having a very strong 23. You can see it in the table here. S&P was up 26%, and much of that gain, or you can see how the final quarter was up 12%. That much of the gain in the equity market at the end of the year was driven by this Fed pivot, the notion that, hey, the Fed is going to reduce interest rates, quit trying to kind of choke the economy off, if you will, and so that caused robust stock performance. And obviously for fixed income as well, that expectations of interest rates declining means that bond prices would go up, right? So you can see over Q4 that the Bloomberg aggregate actually outperformed by 7%. So that if you look at the total year, kind of went from a bad year from the bond market to a pretty decent year, given the interest rate behavior in Q4. That, think of kind of the other drivers of your portfolio that no bones about it, 2023 was a tough year for real estate, right? Particularly in the office sector. We'll go through some data on that downstream, but you can see look at that, the NCREIF property index, right, down 8% plus for 23. And then we've talked about inflation. I guess the only thing I'd observe on the inflation is if you look at that 25-year inflation number, so we're looking at the very bottom right at the table, it's been about 2.5% with with a lot of ups and downs over that period. But I think our personal view is that then when push comes to shove, if the Fed has to choose between kind of sticking to a 2% target over time and wrecking the economy, they'll probably tweak toward having inflation run slightly higher than realizations. Okay.
So really good year to be an investor.
Yeah.
Right.
Yeah. Let me just quickly touch on what are interest rate expectations going forward. And so one of the best guides to understanding that is what's called the Fed dot plot. So the Federal Market Committee, the participants on that, what they do every quarter is each one provides a projection of what they expect interest rates to be over different time horizons. So each of those dots on there represents one person's view of what interest rates are going to be over time, right? And so And these things are refreshed every quarter. So what you see here is what came out last month, okay? That, so you can see interest rates here. And again, what we're talking about is the cash rate, because the Fed controls the short end of the yield curve. You can see right now, looking at kind of 5.25 to 5.5, that's what that kind of horizontal dots are for 2023. That represents current. And you can see there's some divergence if you think about what's going to happen in 2024, right? There's certainly some divergence across individual members of the committee, right? You see two participants are actually saying, hey, let's keep interest rates the same, right? But if you look on average, they're projecting a 75 basis point or 0.75% decrease in interest rates by the end of next year. Okay. And so that's what I mean by this idea of the Fed pivot, right? If we were to look at this back in September, right, that there would be, much smaller magnitude of decrease projected going forward. Okay. So the Fed says 75 basis points of rate decreases. Now, this is where kind of there's essential tension between the Fed and the actual market. Okay, so if you look at projections based from the actual market, and just looking before the meeting right now, that the market is saying, hey, we think the Fed is going to reduce by 1.5%. So actually twice the magnitude of rate decreases that's projected in. But and if we think about what's caused this run up in the market in Q4, right? It's really the market thinking that the Fed is going to be more aggressive in increasing risks, But I guess there's kind of a Callan house view, if you will, that we think the market's getting a little bit ahead of itself, particularly if you look at, again, what's come out recently in terms of economic statistics. Like I mentioned this morning, right, we had retail sales, consumer spending very aggressive or higher than expectations. That if you look at the last inflation print, which was as of December, came in at 3.4%, which was above expectations. So personal view is, hey, the Fed has come so far in fighting inflation that we think they're going to stick to the job. So that what that. Okay, and then I think we have one final kind of wrapping up slide on the market views before we dive into the capital market assumptions. And some of this is review, if you will, that, why has the economy been so strong, right? It's been consumption driven by the consumer. Again, tight labor market. If we look at unemployment right now, we're looking at 3.7%, which is obviously, full employment. That if we look at job openings, still tons of job openings. For example, you look at the JOLTS index, it's gone down a little bit. It wasn't, I think, 6 months ago, I think there was 2 jobs available for every person, right? And that's gone down a bit, but still very robust labor market. Obviously, in terms of tailwinds, right? We talked a bit about, commercial real estate, retail housing market, obviously been challenged. That if you look at mortgage rates, yeah, they've gone down a bit recently, but the 30-year mortgage is still 6.5%, which is more than twice what I want to say you get a mortgage for 3%, right? Back before the Fed started raising rates, right? So those are all obviously things that are binding. Then we talked a bit about risk, and again, I think our central risk, or most likely risk, if you would be, is that inflation remains elevated for longer than expected, which causes the Fed to delay or even potentially scrap rate cuts. And then obviously there's always kind of the wild card out there of geopolitical strife, right? Obviously key driver inflation is oil prices, right? So if you look at oil prices today, we're down at $75 a barrel, whereas, right when Russia invaded Ukraine, I want to say it spiked at 120, right? And so every day, look and you see stuff going on in Yemen or, so those are kind of the wild cards, right? So if there were some kind of action that caused oil prices to spike, that'll make the Fed have to rethink, right? Because that's going to drive inflation. Okay. Okay, so let's dive into the capital market expectations. And here, just a quick summary of what the changes that, again, interest rates went up in 2023, so we've increased our fixed income expectation up to a little bit north of 5%. Increased, incrementally tweaked up the public equity returns. In terms of our inflation number, and again, this is important, right? Because obviously it's important, you know, is this linked into your liability? And in terms of, you know, what kind of real growth can you expect for your plan over time? So in terms of what we forecast for a 10-year horizon for inflation, we forecast 2.5%. Okay, and that's linked to what I was mentioning earlier. Yes, the Fed has a target of 2%, but we think that they would potentially slip incrementally on the upside if it had caused, you know, deleterious effects on the economy, if you will. Another thing we look at is what is the market's expectation of inflation over the 10 years. So what we look at is something called the break-even inflation, which is the difference between, if we're looking at 10-year horizon, we want to look at a 10-year treasury bond, okay, that's a nominal return that includes inflation, and a 10-year tip, which is just a real yield. So if we look at the difference between those, that's the market's expectation of inflation over the next 10 years. And, you know, on Bloomberg a couple minutes before the meeting, like the 10-year treasury now is 4.1%, the 10-year tip is 1.8%. That difference, 2.3%, right? So the market expectation, you know, again, in kind of the neighborhood of our forecast. These things go up and down every day as well. But
I think it's up a lot today, right? The nominal.
yeah, oh yeah. On the back of that strong retail sales, the interest rates went up today, probably 5-6 basis points. Yeah. Okay. So let's dig into and again, at the end of the day, kind of the key driver here for the capital market assumptions, again, particularly given how your portfolio is constructed, is the equity return. So let's just take a moment to dig into that. And so here you can see the fundamental relationship we're using for our forecast here. So the equity return at the end of the day, there's gonna be two sources for return, right? There's gonna be capital appreciation, and then the income you get for the portfolio. Okay, and we'll talk a bit about valuation adjustments as well in a second. So capital appreciation, that I think I mentioned at the start, that we try to link our models to fundamental economic drivers in the economy, so that what we do for real earnings growth is we link it to our forecast of GDP growth over time. Okay, so if we think about our forecast for US GDP growth over the next 10 years, and GDP growth is a real assumption, and inflation's embedded in there or stripped out. 2.5% for real earnings growth. We talked about inflation at 2.5%. So for the capital appreciation side of the equity return, here I'm talking about the S&P 500, we're anticipating about 5% capital appreciation per year over the next decade. And then you think about the income from stocks as well. There's the dividend yield that we're forecasting at about 2% a year over the next decade, and then an incremental increase from share buybacks as well. Share buybacks are another way to give income back to the holder. So 5% for capital appreciation, 2.5% for income. That gets us to that 7.5% equity return for the S&P 500. We'll talk a bit about valuations in a second, because that's important to recognize. And then as we fan out from the U.S. markets to the global markets, that there's a small premium for the international markets, but that really stems from emerging market growth potential. We can forecast higher GDP for the emerging markets over the next decade. It's really from the emerging markets rather than the developed markets. Right. Yeah. Okay. Now we look at valuations, and there's a variety of ways to skin the cat here. Here we're looking at forward P ratios for the S&P 500. And so what you see here is looking back over the past 3 decades, what that has been. And we see some familiar, like look at 1999, right? There's the tech bubble right there, right? You see the ensuing crash. And then you see a little bit of nuttiness around COVID. I mean, things got kind of screwy around COVID as well, right? In 2000. And certainly we would agree with the assertion that, you know, if you look at the US market, valuations aren't cheap. But if you look at where it is relative to long-term historic averages, it's still kind of in the neighborhood, you know, so that, and again, for long-term strategic planning, we only put a valuation adjustment in at extremes. So for example, when we were back in 2019, when things were running up pretty high, we actually had a negative valuation on the S&P. And it's funny because it was really the COVID that ended up kind of driving, you know, we were right, but right for the wrong reason, if you will. Yeah. So, and I guess you back all the way back, right? What were we saying here? We're saying S&P 500, we think it's going to return 5% over inflation for the next 10 years. So we're not talking an outrageous expectation. You know, if you look at the long-term history, for example, the S&P 500, what is it returned over inflation? If you go all the way back to 1926, that number is on the order of 7% real over time, right? So we're saying something a bit lower than the long-term expectation. Okay. Let's see. Okay. Yeah, I think the other piece I just want to emphasize, and I alluded to up front, is, you know, when you think about what is the difference between the stock, so our stock forecast say is relatively modest relative to long-term historical experience, 7.5% nominal return. And now fixed income, because interest rates have gone up, now it's a little bit north of 5%. So you see how that spread is actually, it's the lowest that it's been since the global financial crisis. And that's really, I guess, what I would say is if we were to kind of come back and do this presentation 100 years from now, if you will, that I think we're going to look back and see this period of low negative interest rates is an incredibly anomalous time. It's basically an experiment that didn't work. I think that's fair to say, right? So that, I guess my point is that in terms of the spread between stocks and bonds, now we're getting back to, I would argue, more of a normal period. Yes, it is very low relative to the recent experience over the past 15 years, but you know, I think reasonable from a long-term standpoint. Okay, let's carry on. We can skip the next slide. Okay, so core real estate, we alluded to this, and what you see is just a graph of cap rates. So what that is just the net operating income is in the numerator and divided by the value of the property, right? So what's happening, property valuations, particularly office, have gone down for 2023, and these things tend to go through slowly, right? Because the real estate values are appraised, right? So people don't want to kind of bite the bullet and remark the properties, but certainly you see that kind of in the graph, you see the uptick that's been driven by declining valuations, primarily. I mean, that, and I mentioned earlier, if you look at the return of broad real estate, it was negative 8.4%. This is over the 12-month period ending September. So if we look at our real estate forecast for this year, we've incorporated the fact that we've already taken a bit of a hit. Like last year, we were at 575, so we've tweaked that up to 6% to reflect
over 10 years.
Exactly, 6% a year over 10 years, recognizing that, you know, if there's probably going to be below 6% for next year. But if we look over a strategic horizon,
and almost all from income.
That's right. That's right. Yeah, the days of the huge appreciation. Okay, so we've taken a look at each of the individual asset classes, and now, like I said, this kind of
John, we have a trustee comment.
Yes, please.
I was wondering, with the continued tech layoffs, will we still see over 2024 a deterioration in the real estate market with all the tech layoffs still seemingly rolling?
Yeah, I mean, what we're talking about here is for a geographically diversified portfolio. So we're looking across the entire U.S. That certainly you could envision the scenario where Silicon Valley, for example, may be hit disproportionately. That I guess what I would kind of go back to is that, again, if we look at the entire US economy, the unemployment rate is still close to record lows, right? We're at 3.7%, right? So it's really, I'd say it's really more the dynamic of work from home that is kind of causing the pain in office space than anything about the underlying economy. Well, let me defer to Greg. You probably.
Yeah, you know, another thing so I think we should continue to expect pain in office. And I wouldn't be surprised if we continue to see markdowns for next couple quarters.
Yeah.
In particular for office. And it's because of, you know, the strong properties are gonna do well, the weak properties are not. Yeah. And the cost of borrowing and the need to, you know, roll debt going forward is a bit of a headwind for certain properties and certain funds. But that when you look at real estate across all of the categories, there's a lot more in it than just office. So there's retail, and then there's industrial, which has been on a tear. So when you hear industrial, think Amazon.
Warehouses, yeah, right, yeah.
Exactly. And then multifamily housing and apartments has actually been really strong. You know, rents have been going up. We've got a limited supply of housing in this country. And those couple categories have been quite strong and really have prevented the real estate market from going down even more than what it could have over the past couple quarters. So yeah, I agree that within office, we still have a headwind from the work from home dynamic.
Yeah.
There are going to be big winners and big losers. But within real estate, there are a whole bunch of other categories that are actually doing pretty well, right? When you look at the whole thing together. Did that answer the question?
Yes, that was fine.
Okay, yeah, thank you. Okay, so John went through and he talked about the economy and how we come up with return expectations and individual asset classes. And now we're going to take a look, okay, if we roll the whole thing up and knowing that we're going to be right and wrong about each individual asset class, but the total portfolio is the thing you got to try to get right? Okay, so for the total portfolio, here are the results of when you add them all up using our inputs.
Yeah, that's right. And so expected return for the total portfolio on an annualized basis, 7.5% a year. That you see that we've superimposed at the bottom that if we were to do this exercise 2 years ago, we're only looking at 6% expected return, right? So we've gone from being below your actuarial assumed rate of return to above it, right? And again, what's the key driver at the end of the day? It's that market increase in fixed income expectations driven by increase of interest rates. Okay.
And we weathered a brutal 2022. Right?
Yeah, fair enough. You know, we're kind of, at least the equity market, we're kind of back to where we were 2 years ago, right? Yeah. Kind of 2 years of treading water, if you will. Yeah, that makes sense. The other thing I want to point out here is as you all recognize from actual market experience, this is an expected return. And as we know, in 2023 is a point case, right? Any given year, there's a market variability around what you expect, given by what actually transpires over that year. So our expected risk, you can see about 12%, that's standard deviation. And one way of kind of bringing that to life is by doing projections, because I mean, 12.4 by itself doesn't mean a lot. So if we put the expected return and risk together, what you see on the following slide is our projections for what we expect to transpire over the next 1, 3, 5, 10 years, right? So just to orient you here, when you look at that median, think of the median as the expected return. So you see the expected return over 10 years, again, coming out at just about the 7.5% that we've been sharing with you. Another thing to look at, and so if we look at 1 year, right? If you have a good year, a bad year, you see material variability, right? So that, what we're saying is in a really good market, fifth percentile, think of the fifth percentile would be like 1 year out of 20, like you're up 31%, right? So that, and then bad year, 95th percentile, think of that as a 1 in 20 year on the downside, right? So that's, kind of a 2008, if you will, or something like that, right? So down, whole portfolio down 13%. But the point is, as we move from year to year to, again, I think one of the board members mentioned, hey, we should be thinking of this as a perpetuity. What we really want to think about is, what do we expect is going to happen over a longer horizon for this plan? And are we on a good path, right? And so if you look at the 10-year horizon, you can see that those up and downs are much narrower because the good years and the bad years tend to cancel each other out, right? So what you see here is over a 10-year horizon. Now let me draw your attention to that second from the bottom row, which is what is our projection that over the next decade you beat your actuarial bogey of 6.5%. You can see that we're projecting, based off the current portfolio, about 60% chance of beating that bogey. And what does that mean at the end of the day? To the extent that your assets are beating that 6.5% bogey, right? That's accelerating your progress on the path to being fully funded over time, right? So again, I think I mentioned up top, kind of good news, and I would think that these capital market assumptions are good news. One final thing I just wanted to hit is on the last slide. And again, I think it's a kind of a good internal summary of what we've been talking about is, here's just a simple exercise in terms of, say you want to hit a 7% expected return, okay? And again, 7% expected return north of your current bogey. I just want to draw your attention to those right two charts just to show how much the capital markets have changed, okay? So in 2022, if you want to hit a 7% expected return, you basically had to have a portfolio that had no fixed income. You see how the fixed income was only 4%? Because fixed income was such a drag on portfolio performance back then that if you wanted to hit 7%, you really had to have, and then I would argue this is kind of a crazy portfolio, right? You've got 30% in alts, you've got all equity, So that, again, kind of the good news is that now fixed income is not as much of a drag, right? So that now, more normal portfolios, like a 7.5%, you get a 7.5% return with a pretty normal portfolio, which I would argue is what you guys have now in terms of kind of your risk that tolerance there.
Yeah.
So,
and for years, the industry was pushing to hit a return target and increasing risk, continually increasing risk.
Yeah.
And you see the volatility expectation went from 7 to 17%.
yeah,
So the probability of success, it goes down, right? When your volatility goes up so much. And now we're at a position where we can hit a return and not take on as much volatility in doing so. And that's great. It's a much healthier place for the investment industry to be in, and for plan sponsors, for yourself to be in too, because the certainty of return is going up, and that helps you plan. That stabilizes future contribution rates and that sort of thing. So overall, it's a good story, as John was alluding to. Is that your last slide, John?
yeah.
Okay. All right. So again, we think you're in a position to be successful over the long run, if you continue on your path. And the current asset allocation, we think over a 10-year time horizon, we should expect about a 7.5% return, given the current broad asset class allocation. So we would love to entertain any questions you might have.
I have a question about, on 19, you've got the expected return is 7.5 with a risk of 12.4. And when you come down to where we just discussed,
Yeah.
To make 7, you've got a risk of 8.6.
Yeah.
And then what's our risk at 6.5? I think 59, is that correct? Or that's the percentage I'm making. So what's our risk at the 6.5?
So this is, if you targeted a 7% return, the risk would be 8.6.
Okay.
Now, your targeted return in 2024 is 7.5, my bad, sorry, based on, and you have to pick up about 3 units of risk to get that extra 0.5% of return. Right? To go from 7 to 7.5, you go from, let's call it a 9 to a 12% volatility expectation. Now, I think it's not a straight line. These are bell curves, but you can kind of like triangulate for a little bit if you wanted to, every 0.5% is about 3 units of risk. Within kind of the heart of the belly of that distribution, that's probably a pretty fair relationship, Richard. I'm not sure if I answered your question, so if not, please ask again.
Well, I guess I'm having a senior moment. What is our estimated rate of return that we've adopted? That's what
6.5.
Yeah, so my question was around what is the factor at 6.5? We've got them listed at 7.
We'll have to run those numbers for you, Richard,
Okay.
but would it be about 7?
Are you saying how much fixed income would you get having? Go ahead, sorry.
If you targeted a 6.5%
Yeah.
return,
Yeah,
what would be the volatility of a portfolio?
yeah, it would be about 7% because, like if you just had all fixed income, your expected return would be 5.25, and the volatility of fixed income would be 4.5. So it'd be about 7. Yeah, I think that's right.
Thank
Sorry.
you. That was the question.
Okay.
That answers it.
So if I could, this gets back to my question that we had a meeting or two back, which is, what's your definition of risk? You're applying the word risk to standard deviation, which I don't think that, in my mind, is the same thing as risk. To me, the risk is the stock market, the global equity market, you might say, takes a nosedive for 10 years, not 1 year, or not flutters, isn't frothy. To me, standard deviation is more about frothiness than it is about a collapse of the markets. So that's the way I look at it. And, when you look at the past performance of the U.S. stock market, we went from a period after the dot-com bust, actually after the real estate bust, 2009, 2010, where the markets returned substantial returns. I think it was like about 10, 12% U.S. stock market. And the standard deviation wasn't that great during that time period until you got to the 2020 COVID. And since then, we've had a lot of volatility, but there's been a lot of things going on. There's been interest rates spiking up very quickly by the Fed from virtually 0 to over 5, and uncertainty about when they're going to lower that. So supply chains reconnecting worldwide, all sorts of uncertainty in the world economy that's created a lot of volatility. But it's actually, if you look at the stock market, it's been volatile. It's had a high standard deviation, but it's actually gone up pretty significantly from the drop in 2020 to now, depending where you want to measure it. So it's kind of flattened a little bit here at the beginning of 2024, but it had a rally in December. So to me, the volatility, the standard deviation, the frothiness of the equity market, or actually bond market too, is not terribly important when we know we only need to draw down barely 1% of our portfolio to make annual contributions to the plan, because we have so much money flowing in. This is not like, as I keep saying, this is not like an individual's 401k for an individual who does not have a public pension and has a small Social Security and is trying to have a smooth runway for 30 plus years with their drawdowns on their 401k. We're talking about withdrawal rates of a barely 1%, not 4.5%, 5% that a lot of retirees are looking for.
Trustee Jardy, I think you're spot on. There are a number of ways one can define risk, right? And what do you mean by risk? And standard deviation is just one way to define risk. So standard deviation can be thought of as the certainty of your projection. You know, what is the certainty we have around the S&P 500 returning 8% a year, right? And then it's also how certain you are that it's going to happen in any individual year as well, right? So standard deviation has, you know, a couple applications there. There are other definitions of risk. What's the risk of, you know, permanent loss of capital? What's the risk of 10 years from now having less money than you have today through a permanent loss of capital? And you can use that standard deviation number with math to come up with, well, what's the probability of that happening? And that's kind of one of the uses of standard deviation to answer what I hear your question being, which is, what's the probability of we having less money 10 years from now than we have today, right? Because that would be a bad scenario, right? Yeah, and over that time period, your liability is growing too. So your funded status would be a lot worse 10 years from now. So we use the standard deviation to come up with that as well. And you'll see the probabilities that John calculated based on standard deviation is, you know, you're in a 60% chance essentially of being north of your discount rate, which means that you're closing your funding gap over that time period. You know, kind of pretty consistently. So that's a couple ways to use standard deviation, a couple definitions of risk. There's also liquidity risk, and that's also what I hear you talking about. And I agree with you. And when we did the last asset allocation study, we came to the conclusion that you don't have pronounced liquidity needs. And you know, there are other plans out there in the United States that are in major negative cash flows relative to their corpus, and that's not you. You're in a really good position, and you know, you can invest like you would, you know, without tying your hands due to, you know, these massive liquidity needs. You don't have that, which is a good thing. What are there any other questions from the group?
Well, just Greg, so I'm just looking at your projections, Callan's projections, I should say, going forward for the S&P 500, you know, U.S. large cap, and
Yeah.
It's showing a standard deviation of projected of 17% going forward. And when we do a back test of an index fund of what I would call quality companies, large cap quality companies, and that would be the Vanguard dividend appreciation. So these are companies that have had profits for more than 10 years, have had so much profits that they've increased and consistently given out dividends for 10 years. It's a quality screen more than it is, you know, a dividend screen. It had a standard deviation since its inception in 2011 of 13. So if reducing standard deviation is of high importance to this fund and increasing probability of achieving our target, why would we not consider substituting some of our S&P 500 for a subset of the S&P 500 with a smaller standard deviation?
I mean, you could. What we're doing right now, though, is coming up with a strategic asset allocation as opposed to coming up with a manager selection, right? Or a fund selection. You know, we say, okay, if you invest in the stock market, absent any tilts you put in the portfolio, this is your return, this is your risk expectation. The next step of the process is to say, well, what do you do within each asset class after you know this? And, you know, do you believe in active or passive management in different markets? Do you overweight small cap relative to large cap? You know, who is the best manager within each category? You know, those are second and third order effects. The number one most important thing you do, though, is what John's showing you and talking to you about here today. Now, this group has a investment belief statement that, and it's one I agree with, that, you know, the U.S. large cap market is efficient, and we invest in the S&P 500 indexed for that reason, right? That decision has worked out pretty well for the investment program for the past 10 years or so. But that's why you don't have a large cap, low vol equity portfolio, or you know, a large cap healthcare portfolio or something like that. Because, you know, those volatility numbers are certainly, you know, they experience that in the rear view, but going forward, you don't know if that's going to persist, right? Is that going to persist going forward? That's a bigger, you know, belief statement that, you know, I don't know if there's an academic reason to believe that. You know, you can look back and say this is what happened, but what's the reason it's going to persist in the future is the harder question.
My point in bringing it up is loading up the portfolio with bonds is only one way to reduce standard deviation. There are other ways through mutual fund selection that you could accomplish the same thing and have higher returns.
Got it. Okay. What other questions do we have?
Okay.
Okay.
Is there any
All right.
public comment?
There is no public comment.
Thank you.
Okay. Well, thank you all very much, and we look forward to seeing you next month.
Thank you, Greg. Thank you,
Okay.
Kellen.
Bye-bye.
Bye. Okay. We're on to agenda item number 5, discussion. Yes? Okay, I wasn't clear on, I thought Callan might be doing all of them, and so then when they said that they're leaving, okay, so this is Robert. Thank you, Robert.
Morning, trustees. So let me kind of set the stage here. This presentation is in as sort of an educational session for you all, because we're going to have Callan here with the quarterly investment report next month, December quarter, which was pretty good. Callan already mentioned that. You may or may not. Still on? Yeah. So what we thought we'd do was go through some of the characteristics that Callan regularly reports on in each quarterly report. The quarterly report's quite long. It's 120 something pages, and they report on different metrics for each fund that we have. And so we kind of wanted to dive into detail on what those metrics were so that trustees next month will have a little bit more basis for what some of those numbers mean. And so that's what this presentation is going to run. We're going to go through the equity characteristics, the fixed income characteristics that they report. And currently, Callan doesn't report too in-depth on the real estate investment characteristics, but that's something that we're probably going to do in the future, depending on board direction, of course. So that's where we're going to start, and Judy's going to run the presentation for me. Appreciate that. But let's go ahead and go to the third slide. So we're going to start with the equity characteristics. The first one that they report in those reports is the market cap. This is the total value of a company's outstanding common shares owned by the stockholder. And right below here on the left-hand side, you can see the calculation that I've sort of laid out for this particular company, Dynavax at June 30, 2023. If you were to go out and look at their 10K report, find it on their website, you'd find that the shares outstanding are 129 million. And if you go multiply that number by the share price, that's going to give you what's called their market cap. And this is how we differentiate different company sizes in the portfolio. So when we talk about the S&P 500 being a large cap index fund, that means that all of these companies are a certain market cap size. And so that's this calculation here. In our example, Dynavax being a $1.6 billion market cap, that's a decidedly small cap company. And on the right-hand side, I've got the size categories broken out by the different dollar values. Micro cap being the smallest, small cap being a little bit larger, 250 million to 2 billion. Mid cap being a little bit larger than that, from 2 billion, in between 2 billion and 10 billion. Large cap being 10 billion to 200 billion. And then the mega caps being the largest in the world, greater than 200 billion. Since I made this presentation, Apple and Microsoft have actually switched market cap positions. So Microsoft is now the largest company in the world. Apple's number 2. This is pretty straightforward. When you're looking at a fund and you're looking at companies within a fund, and Trustee Shoemaker commented on this before, I think it was with regard to Fidelity. Why does Fidelity have companies that appear to be outside of their cap structure? That certainly can happen. And as the fellow from Callan pointed out, they're really only required to be that particular market size at the time. So at the time that Fidelity purchased, I think AutoZone was the example, they very well could have been a mid-cap company in the moment. Over time, that share price increased, and the shares outstanding may not have increased. They may have increased depending on particulars of a company. And so that market cap can creep up. And it doesn't necessarily mean that a company has to sell that business. They can just hold it, and now they've got a large cap company inside their fund. That happens all the time. As an example, Microsoft's market cap in 1986 was 763 million, and it moved up to 3 billion in 1989, 22 billion in 1994, and 236 billion in 19. And they're now the largest company by market cap. So we can move on to the second slide, unless there were any questions in particular. Slide is the price to forecasted earnings. This is a variation in the price to earnings ratio that attempts to predict a company's future. Of course, it is only an expectation. Forecasted earnings are unknown. Everybody has a different model that attempts to forecast earnings for a given company in a given industry in a certain economy. The technical calculation for this is the price per share divided by the future earnings per share. And that gives you a price to forecasted earnings of some number. In this instance, I picked AT&T. They're a long-term, stable company, and they're your typical value company. So they're a good example of a company that's stable, long-term, and doesn't have large price fluctuations or business operation fluctuations.
What time frame is the future earnings per share? Is that per quarter or is that per year?
That's typically a 12-month forward, looking forward. And that changes every quarter. Every quarter, a company releases, their previous quarter's earnings, and those change in earnings or change in business operating environment can change the forecasted earnings. So that moves around all the time. As of January 8th, this was the calculation for AT&T, but that can change every day. And then kind of the last thing to say is that this ratio in particular, you should compare companies that are in the same industry. It's really not fair to compare AT&T to somebody like Google, for instance. Different operating model. Let's move to the next slide, which is the price to book ratio. This is an extremely popular ratio that you will see probably in a lot of different literature, and you may want to calculate on your own. It is the comparison of the market price per share to the book value per share. This is a little bit more complicated in that the book value depends on the total assets and the total liabilities of the company, and the number of shares. So at the bottom here, you can see the exact calculation, and I've done the calculation for AT&T as of the September quarter. It's the price per share divided by the value per share, gives us a price to book ratio of 1.04. The popularity of this ratio, like I mentioned before, is pervasive, and one is sort of I would say the gold standard, the baseline number for this ratio when it comes to really every company, but one is sort of the breaking point. One or below, those are typically searched out for by a value investor looking for a good value for a company that is undervalued for a number of different circumstances. Numbers that are greater than one, those are typically going to be your growth companies. And this number can be massive. It could be 40, 50, 10, it could be 5. But a good thing to keep in mind when we're looking at the fund reports from Callan is 1. So you want to see, as a stable long-term investment organization, it'd be nice if we saw funds that were relatively close to 1. Now, I'm maybe being biased when I say that. You all may have different opinions on that, but 1 is sort of a key conservative number that is nice to see in these. On that. The next metric that Callan reports is a dividend yield. This is the return earned solely on dividend payments. And so again, we can see for AT&T, I've done the dividend yield calculation. 4 quarters, AT&T pays out a certain dollar amount. You add those dollar amounts up and then divide them by the price per share. That's the dividend yield. If you just held this stock for a whole year, you would essentially earn what we're earning on some of our fixed income, surprisingly. Value companies, Value funds typically pay out greater dividend yields than growth or other types of companies. The reason for that is that a growth company, instead of paying out earnings, dividends come from earnings, instead of paying those earnings out, a growth company will keep those earnings and reinvest in the business and, spend that money internally instead of sending it back to the investor. Value companies typically have lower growth expectations. They're a more stable business. Earnings that they make, they're able to pass that along to investors in the form of a dividend yield. Our funds in particular range anywhere from 2, maybe 1.5% dividend yield up to 6%. Of course, there are dividend yields that are higher than that if you're looking at other subsectors, REITs, business development companies, master limited partnerships, but for us, we sort of can think about that as basically growth in value. Growth companies are going to internally invest that money. Value companies are going to pay out dividends. The final slide here of our equity characteristics are forecasted earnings growth, and this goes back to Trustee Land's question: is how far in the future are these estimates made? In Callan's case, this is a 12-month forward estimate. And the other metric that you're going to see in those reports is the MSCI combined Z-score. A Z-score just tells us where a particular value or measurement is in relation to the population of scores. In this case, having a positive number on the Z-score is going to indicate that the company or the fund is more growth-oriented, and having a negative number is going to be associated with a more of a value type company. There are different variables that go into those calculations. I kind of mention it here. MSCI uses 3 value variables and 5 what they call growth variables, and they're actually a function of some of the other metrics that we just looked at: dividend yield, price to book, forward earnings growth, sorts of questions. Those are the 6 metrics that Callan's going to report. Any questions on the equity characteristics? Okay, we'll move on to the fixed income characteristics. The first one, probably the biggest one, depending on how you want to look at it, duration is always on people's mind. This is the measurement of bond price sensitivity in relation to changes in interest rates. And here, I've gone back to early 2021, sort of just to show the period of what has been happening since the pandemic lockdowns. Well, since the Fed started raising interest rates. This period is covering the Fed funds period when it went from 0.08 up to 5.25, 5.33. And so what we can see for our 2 funds, they're relatively close in duration. And over time, that duration has sort of crept up from around 5 in the instance of Dodge and Cox, up to 5 3/4. And PIMCO has had a little bit more duration. That means they're a little bit more sensitive to changes in interest rates, from about 5.8 to 6.18. And in fact, PIMCO now appears to be in the process of increasing their duration slightly. So the Bloomberg Ag in September, the duration was 6.15. And as we can see here, PIMCO's a little bit longer than that. What that means in practicality is that for every 100 points of interest rate change, a 1-point duration would change by 1%. So in this instance, as of September 30, Dodge & Cox has a 5.72 duration. For every 1% change in interest rates, Dodge & Cox fund is going to change by 5.72%. Traditionally, MSERA has had these numbers be short, what's termed short of duration. These funds have usually been, they've had less duration than the Bloomberg Ag, the benchmark. And that's a good thing in rising rate environments. That's been a function that's helped mitigate losses in the bond portfolio over the last 2 years. As of right now, the chatter in the investment world is how much duration do we want to be taking now? As Callan mentioned, interest rates have gone up. This has appreciably changed the expectations, return expectations for fixed income. And now the question is, well, how much duration do we want to take on additional? Do we want to take any additional on? And the reason why you would want to take on duration is because if we think interest rates are going to drop, we would like to have increased duration exposure because that's going to raise the capital appreciation of our bond. As interest rates drop, price goes up, and inverse. So that's sort of where we are now. Any questions on duration? Average life is the next metric here. This is really effective maturity. This is the length of time considering all call options until a bond reaches maturity. So some entities have an option embedded in their offering documents that allows them to call the bond early, given certain conditions. It could be a condition of the financial stability of a company. It could be because a geopolitical event happens. It could be because of interest rate changes. And typically, this number is going to be lower than how long you would think your bond is available. You may buy a bond from the county thinking, I'm going to buy 30-year POBs from the county of Mendocino, and you might find that after 10 years or 12 years or 15 years, the financial environment has markedly changed, and now there's an incentive for that entity to call the bond. They don't want to be paying the 7 or 8% interest rate that they were paying. They want to call the bond, issue new debt to pay off the old debt, and now pay maybe 4% or theoretically lower. And the county has recently done that with a number of their own bonds. In this example, again, the same period, we can see how the effective life for Dodge & Cox has interestingly sort of creeped up, whereas PIMCO has sort of just stayed the same. And the big difference there, the reason for that is PIMCO uses a strategy with a lot of futures contracts and different sort of option derivative contracts in order to keep their effective maturity relatively stable. If we move on to the next slide here, we've got effective yield. This is the return on a bond if you reinvest all the interest payments into a similarly yielding instrument. You may or may not be able to do that in reality, but it's an interesting way to think about it. We reinvest in our funds. So the income that both of the Dodge & Cox and PIMCO spit off, we immediately reinvest that. And so this is actually a fairly good example in our case for what our yields are. This is sort of like a dividend yield on the equities, but this is a debt metric. Again, for the period, we can see how they have markedly risen from somewhere around 2% in December of 2021 to north of 6% today. So that's been a good thing. If you go out and you look at a metric for a bond fund online, either of our funds, any other fund you can find, you're going to see reported something called the 30-day SEC yield. That yield is a different calculation, but it's similar in that it gives you a sense of how much, what the yield on the fund would be if you were to invest in that fund, given a few other specific metrics. But I guess that's all to say that number will probably be lower than this number here. So if you were to go out and look at those two numbers, say you know of a really good bond fund in your opinion, you go check it out and you see that SEC yield on what you thought was a stronger bond fund, that number is lower, and you're sort of wondering why is it lower than these reported metrics in the Callan report on Dodge and Cox, for instance. There's subtle differences in how the number is calculated that I don't necessarily want to get into, but just know that SEC 30-day yield is going to be lower than effective yield as reported in our report. If we move on to the next slide, this is the final slide, coupon rate. This is just what it sounds like, the interest paid on a bond. Very simple. This is the number that you might see if you were to go look at a bond offering. 6% for a certain entity, 5.5%. Of course, that number's all over the map depending on what credit quality of the company is. But here we can see sort of the same exact behavior that where these prices have increased, fairly markedly over the last 2 years. They've gone from about 2% or 3% to a little north of 4, or right around 4. And that's just a function of interest rates rising all across the board. I guess I could point out that treasuries right now, depending on what tenor you're buying, they're anywhere from 5.25, maybe 5.3 or 5.4. The 10-year is just auctioned at 4.5%. Municipal bonds go on top, adding another 1 to maybe 2 or 3%. Investment corporate bonds are right around that same rate. So a 10-year corporate bond might be 6 or 7% at this point. And depending on what type of high yield bond you want to look at, that's a lower credit quality or floating rate collateralized loan obligation. That's somewhere between 3 and 5% above the treasury rate. So these are very core. These are investment grade core. They're really not that much higher than your 5 or 10-year treasury note would be. Any questions on those? Thoughts? Lastly, we can move on through the real estate characteristics. Now, Callan doesn't necessarily report these characteristics that we're going to look at today. This is really, this is something that we're kind of thinking about. This might be something that we can report internally to you also. But I thought it would be a good exercise just to have everybody be aware of some of the characteristics and things that are going on within the real estate managers that we have. REEF and the Barings Corp Property Fund are our two managers. When we wonder what sectors and regions are our investments exposed to, these are them. They're both core managers. So they've both got this very, what I would say is they're basic, they're non-esoteric regions. They're retail establishments, they're office establishments, they're industrial. These are the warehouses Callan alluded to earlier. And I'm calling them residential, but they're really different types of apartment complexes that they're involved in. They're not owning single-family dwellings. These are Class A, all Class A buildings also, I guess I would point that out. So they're all high quality, different, grocer anchored, or in the case of residential, they're potentially high-rise apartment buildings. And so we can see that they're both kind of broadly similarly situated. They've got similar retail exposure, they've got similar office exposure, and they've got similar residential exposure. Really the big difference between these two is Reef is overweight, specifically industrial. It's worked out for them. And Barings, even though, they have less exposure to industrial, they still have a large portion of the portfolio in industrial, but they've also got this small segment of self-storage exposure. So that sort of differentiates them by property type. In terms of the regions, they're both very, very similar. Most of these core funds want to be in the South, the Sun Belt, and they want to be on the coastline. What I'm calling north here, that's sort of the Rust Belt. There's not as much activity in the Rust Belt region. Populations have been moving south. Florida and Texas are the big move over the last year. If we go to the next section, next slide here shows the income and appreciation for Reef. Now, it is no secret that real estate has been heavily impacted over the last 2 years by rising interest rates, and we can really see that here in the appreciation return value. Typically, real estate returns are separated into income and appreciation, income being the rental stream, and appreciation being the change in market value over time. In this instance, we can see that the income's fairly stable, around 3% for almost all the periods. The longer term's a little bit higher. And the appreciation, we can see recently, has really fallen off a cliff. This is just a function of the rise in interest rates. On the right-hand side here, we can see this is actually mislabeled. That says income, but that should be total return instead of income on the right. So that was my error. Reef's inception is October 1st, 1998. Sarah first invested February 12th of 2004. So we're going on 20 years in this particular fund. The next slide is the Barings information, same information just for Barings. Here we can see a little bit more of a write-down on appreciation. One thing I would note is that Barings was first out of the two managers to start writing down office properties in the September 22 quarter. So that's impacting their return here on the capital appreciation a little bit more than Reef has only really begun to write those down in the last year. Barings was really out in front on those write-downs.
Question for Robert. So in either case of Barings or Reef, do they have an outside agency or auditors or somebody to make their own appraisal of the valuation of the properties?
They do. Both of them have policies related to that, and they also have independent contractors, I would call them. Absolutely. Every quarter, there's sort of a rotating schedule of appraisals.
And do we know anything about the validity of the outside valuation?
I don't know either one of the companies particularly well. I guess when you say, do we know about them, what exactly do you mean?
Like standards, like there's GASB, there's governmental accounting standards for government agencies to report their balance books. And I don't know if there is some sort of industry standard or government required standard for establishing the valuation of what, I don't know if these are considered public or private equities.
They're private.
So, because I know just in general that there's been a concern about the private equity market and are they honestly accurately disclosing the current value, because they're not traded like a common stock. There's not a daily or hourly valuation established by the people who buy and sell stocks.
Yes, so I don't necessarily know the standards related to real estate valuation. What I can say is in terms of the private equity argument that I've also heard related to valuations, you know, those are a function of balance sheet and income statements of private companies. They're more opaque than an entity like real estate. Real estate returns really come from income and appreciation. The income is less opaque, I would say, than a balance sheet. You know, there are a number of different asset classes on a balance sheet, whereas an income statement, you know, has rental income, prices of utilities, maintenance, things like that, kind of like ours would show. So, you know, while I don't technically know that standard, I would say that the level of visibility here on real estate is much greater than a private equity type investment.
Yeah, just finally, I think the concern with real estate, and I'm not saying it's a bad investment for us or it's a bad sector for us at all, but I'm just saying it's not entirely liquid in the way that some other assets are. And so because the real estate market tends to go through booms and busts in terms of the volume of sales, when there's lots of sales, there's lots of comparables to really have a pretty good read on the valuation. And when sales kind of grind to a halt, as they mostly have with the higher interest rates, because people are waiting, I don't want to give up my low interest rate mortgage now and take and sell and buy something else that has a higher interest rate. So a lot of people are sort of frozen. I know that's particularly the case with residential, but it would conceivably be the case with some commercial businesses expanding and moving into something else, or downsizing and moving to something else. That it's just not as easy to establish, even from the outside, what the true valuation today is of a piece of real estate when there are so few comps.
I mean, that is absolutely the case across the nation. You know, that's sort of the situation that we find ourselves in now. Transaction volumes are down, you know, costs are high, debt levels are high. There's folks don't want to step into these longer duration type investments because of the uncertainty. So transaction volume is down. You know, but my guess is that the primary driving factor here is literally just interest rates. If interest rates were to come down a little bit, transaction volume goes back up, and there's sort of that clear visibility on what you're building down in downtown Manhattan or San Francisco is actually worth on the market. The last slide, second to last slide here, occupancy rates. Both of our managers have had occupancy rates that have changed relatively little. Probably the biggest change has been in office real estate. So in the instance of Reef here, we've got the current occupancy rates. They're really all exactly the same, aside for office. Office is down a fair amount. Pre-pandemic, 28 to 2019, that Reef number of 81% would have been closer to 89 or 90%. Other than that, they're relatively flat. In terms of Barings, they've actually kept their occupancy rates fairly high, even related to, even when you compare that to pre-pandemic, those numbers have stayed high. You know, the trade-off has been lower income. Right? We want to keep our tenants here. We want to keep them happy. We want to try to lock them up. But we're going to have to trade a little bit of that income. We're going to incentivize people to stay longer than they maybe otherwise. So in Barings' case, their occupancy has remained high, and that's a good thing. But they've given up a little bit of income to secure that.
Wouldn't some historical data on that sheet be a little more helpful than just the photo of that day?
No doubt about that. I only had so much room to put on there, you know. But, you know, if that's something that the board would like to see or trustees would like to see, we can definitely work something like that up.
Well, I guess it's worthy of a comment that if you take this and track it over time, like you do in the income column for the pages ahead, you can see, oh, these guys used to be fully packed, now they're down 8%. What has that done? Oh, their income looks great, though.
Yeah. I certainly can do that in a future update for them. The final slide here is the leverage slide. This basically just shows us, you know, how levered up, how much debt risk is being taken on by the companies. And luckily to say, this number is relatively low. The National Council of Real Estate Investment Fiduciaries and the Pension Real Estate Association are two lobbyist groups that have made standards related to leverage reporting standards. And this is technically what that is. What's the fund's economic share of total leverage divided by the fund's economic share of total assets? And both of these numbers are on the low end. On the right-hand side, we can see a table that shows the leverage by type of real estate fund. So we've got two core managers. We would expect their leverage to be less than 40%, and they most certainly are. They have inched up a little bit since 2018. The 2018 levels were, you know, less than 20 or around 20, and now they're just north of 23, and in Barings' case, a little above 30. But they're still well below the 35% limit set by the National Council of Real Estate Investment Fiduciaries, so they're right in line with where they should be.
So Robert, can you just put this sort of in plain English? So you're saying that their debt to income is low?
Their debt to net asset value,
okay,
is low.
So for $1 million, one of them's in debt 220, and the other one's in debt 304,000.
Yeah. And that takes into effect also like joint ventures. They could have joint ventures where they're working with somebody. They, you know, Barings does joint ventures a little bit, so that's sort of getting into this opportunistic bucket. But it's a very small portion of the portfolio, so it's sort of a technical term. But it's really just what's their debt, what's their net asset value. That's that ratio that we're seeing here. That's the end of the presentation.
Thank you so much. That was great.
You know, I think anybody that buys anything outside their own home ought to have this in their pocket, just to understand what they're looking at. Good job.
Any questions, thoughts?
I've always believed that you learn by doing, and that was a beautiful job of teaching us and I hope it also helped you clarify the work that you do daily. Have to put it out and have an interested group, but one that certainly isn't as knowledgeable as you are. Some board members may be accepted, but I appreciated this work a lot. Well done.
So, Robert, are you going to do the next 4C?
Well, I certainly could mention it. Let me pull it up real fast. I don't think we did anything too complicated. We had it was a great month. The quarterly returns are good.
That's all we
And we didn't do any rebalancing. We're very close to our targets. We've backed off of our real estate at this point. This report doesn't have an updated real estate value, but I do have an update internally, so I know that we're quite a bit closer to all of our targets. We're only really meaningfully overweight on infrastructure. And we're maintaining the same strategy to try to bring that down by by taking cash distributions instead of reinvesting interest in the fund.
That's interesting to me. I mean, with the, what is it, the big bill that we've just passed, and they're shoving money out everywhere into the country. I hate to say it's an opportune time to be in infrastructure. Too bad that we can't make some adjustment there. Wow. Inflation Act.
So, just a question, do we know if the markets across the board were down? Now, dividends from stocks would also be down a little bit. Bonds may have the same dividend or yield. But if we didn't want to sell because the markets were down across the board, would the interest payments on our bonds, would the dividends that we receive, would they equal that $8 million cash flow out that we need from the fund?
They're a little less than that, but they're maybe 5 a year.
And we went to some cheaper index funds, we get that cash flow out down to 7, we'd only be short 2.
Well, I think the only thing that I would add when thinking about this, and it is sort of counterintuitive, but having a riskier portfolio in some senses actually can minimize the future contributions of the plan. Right? If we back off too much in terms of our willingness to take risks, that is likely going to, over a longer period, that's going to decrease the prospective returns that the portfolio is going to make, just by math. And that in turn is going to cause plan sponsors to maybe have to pay more. I'm not saying in every instance that's going to be the case, but I can think of at least one specific example, Arizona. Doris, I think you saw that presentation at Sackers, where their CIO talked about some sort of counterintuitive findings that their system found, which broadly was, don't try to just cut down risk in terms of return, be a little more deliberate about where you want to take it. Don't just constantly think about, we want to lower our risk. By lowering that risk level, you're sort of hamper the long-term ability to grow a fund in some sense.
So I
which-
absolutely agree with you. Robert, that's the point I've been making for several months, is that we had Callan in here about 8 months ago say, de-risk your plan, throw more money at low-performing bonds, which over the last decade yielded barely 2% for this fund, which dragged down the performance of the portfolio over the last decade. I know they're not going to perform only 2% for the next decade, but they may not be accurate in their expectations over the next 10 years on bonds, just like they were inaccurate 10 years ago on their expectations for bond earnings. And we were not protected from the 2022 downturn in the market, because the downturn in the market was driven by a bunch of things, but including the Fed increasing interest rates, and bonds, when they were yielding so little, so close to zero, couldn't, it just devastated the bond market to go from close to 0 to 5.5 on federal treasuries.
Well,
So I know we're not there anymore. I know, but I'm just saying, it's like, I totally agree with what you just said. This fund can take some risk. This fund can take some frothiness. We only need to pull out about just over 1%. And that's why I'm questioning one way to do it. It seems to me, if the markets were to just collapse on us for 2 or 3 or 4 years, one way to do it would be to largely meet our cash flow. It sounds like we just don't reinvest our dividends, and that by itself, I mean, it just shows how little we need to pay out of this fund right now. And I think all the more reason to not take risk off the table and not aim so low at this ridiculous 6.5, I'll say it's ridiculous 6.5 bogey that we've set for ourselves, when we should be aiming for 7.5 or 8. I don't know anybody that only wants a 6.5% return on their own investments over a 10-year period.
well, so there's a lot to unpack here, but this program has had core fixed income managers for the last 30, 40 years. There's only investment grade exposure, short duration exposure. The portfolio doesn't have, any other type of fixed income exposure. There's a lot of other types out there, a lot of different flavors of high yield. There's a lot of different floating rate instruments. When we get to the discussion about the fixed income portfolio, I think that is something we're going to talk about, is what other types of fixed income risk are we willing to accept? Credit risk. What types of, senior loans? Do we go with collateralized loan obligation funds? There are a number of other options out there that can do well in the current environment that we're in. We could even extend duration. That's the most popular hot topic in fixed income today, is we need to load up on 10 and 20 and 30-year treasuries. That way, when the Fed cuts rates, we can sell off all these bonds that, for huge capital gains. That's not necessarily an approach that I think we should take, but it's something to be aware of and a way to potentially consider juicing the fixed income, even though broadly there's not much need for it. If the simplest, most stable part of our portfolio is getting 6% yields, we're very close to that 6.5% broadly as a fund. There's a lot to think about.
I'm sorry, I don't know what you're. Is there any public comment?
There is no public comment.
Okay, thank you. I think it's time for a short break. Maybe be back here by 20, a 10-minute break would be. Does everyone agree, or?
Sure.
Okay.
Oh my God. So how's your property?
Okay, are we ready to go back? Okay, so I guess somebody helped us with the heat. It seemed to be getting pretty cold in here. Okay, so item number 5, discussion and direction regarding board work plan and strategic plan calendar quarterly review.
Thank you, Chair Cavness. The board work plan and the board strategic calendar are in your packets. I'm happy to answer any questions. There is a cover memo this time. I just wanted to bring up a couple of points. The board work plan format has been changed a little bit. If we have completed all of the action items under specific objectives, those lines have been collapsed so that detail no longer shows. Additionally, I wanted to bring your attention to a couple of items that are slightly behind schedule, one of which is developing a process to identify and report a short list of current and emerging markets, emerging risks to the board. We should make substantial progress on that once we contract with a firm for an enterprise risk assessment for MSARA, and we do have someone now lined up. It took us a little longer to locate a qualified individual or firm to address that. So I'm happy to answer any questions that you have regarding the work plan or the strategic calendar.
Dan?
So I do like the format. It keeps improving for the work plan. I think it's really concise. I'm just wondering, because staff is accomplishing a number of goals, might it make sense to have an addendum or something later that shows sort of the tracking of the goals that were accomplished?
We certainly can, whether it's provided as a list of like accomplishments for the year. They still are on the plan, and if we expand it, we have the detail of the items that were completed. Additionally, since we have completed items, monitoring the strategic plan process is part of the board's, purview to take this opportunity to identify and incorporate any new action items. So again, like goal 1 had an objective of exploring alternative investments. We provided some education last year that met the board's desire for an educational piece on private equity, but the board could certainly establish a new action item to say they would like more education on alternatives and give us some board direction there. So there is a request in that board memo that if you have any items that you wish to propose for action items, that you submit them to me and we can schedule those for discussion on a future agenda item. As far as tracking the metrics that have been accomplished, I'm happy to do that. If you have a preferred format, please let me know.
I think my thought would be, I don't know when this was started in a slightly different format, but I think it was maybe 7 years ago, 8 years ago. If it can go back that far, since we have the documents, maybe it'd be great, just like I said, maybe it's an addendum that shows between this date and today, these are the items that were, set as projects and were accomplished.
We have all of those historical reports that were provided to the board, and we can pull that information together. I can certainly put that together either as in a chart like this or just in a list of accomplishments in the year in which they were accomplished. Okay.
If you could, you did a little bit on the calendars, include every acronym at the bottom of the report for people who are going, oh my God, because if the public looks at it and, VCP, ESG, XYZ, just gobbledygook to a lot of people.
Yes, I'll try to include a key to define all of the acronyms used.
Great, looks good.
Any further discussion on?
Could we have
Calendar.
could we have a board presentation on how to use Portfolio Visualizer so we could all see it?
If that's the pleasure of the board, we can schedule an educational piece on anything the board would like.
I'd be happy to provide some alternate funds to look at compared to our existing funds.
Maybe you just want to supply your most favorite websites and the board can go explore if they like.
Is, no, do you want to move forward to the strategic calendar or? Okay. Okay. So let's move forward to item 6, budget amendment. Robert, would you like to speak up? Okay.
I'll go ahead and take that one. Thank you, Chair Cavness. There is a requested budget amendment to increase total budget allocations by $84,000. That includes $36,000 for consulting contracts, $10,000 in technology, and $38,000 in legal. Excuse me. The consulting contracts originally included an allocation of almost $28,000, primarily intended for the internal audit assessment. MSERA is contracting with a firm, Audit and Risk Management Services, for an entity-wide risk assessment. The allocation of funds was also spent on the selection of Poblowski Research, which is a public opinion research firm to help us do surveying of our membership. When I was making less progress than expected on finding an audit firm to come in, I went ahead and worked on finding someone to do a survey of our membership and made a contract with them and then found a firm. So we wound up with both of them in this fiscal year that was not actually anticipated when the budget was drafted. Technology represents an increase of $10,000, primarily to cover the billable hours for pension gold modifications. As you know, we've had a number of work orders to make amendments to the plan design to fix the general ledger function, and also this includes implementation of the separate accounts provision that should go into testing next month. Additionally, we're requesting an additional allocation of $38,000 to legal. The original budget allocation was $187,500 allocated to Disability Council in the amount of $30,000, Board Counsel for $43,500, and $72,000 for Fiduciary Council and Tax Council at $42,000. The proposed increase is due to higher than expected expenditures for Board Counsel. Based on the fiscal year-to-date expenses, the projected annualized expense for Board Counsel are estimated now to be at $112,000. The requested budget amendment will increase the Board Counsel allocation to $81,500, which, when combined with funds allocated to Disability Council, which are not anticipated to be used, will provide the necessary funding to cover legal expenses anticipated for 2024. This does have an impact to the administrative budget cap. It increases the administrative budget, but it remains below the statutory limit of $2 million and also below the statutory policy limit of 21 basis points. If you have any questions regarding the budget amendments, I'm happy to entertain those now.
Is there a motion?
I have a
I move
question.
staff recommendation.
Go ahead, somebody second that
A
one.
second?
I'll second.
Any discussion on the motion?
Sure. So these are based on to-date expenses already this year, so basically half a year's expenses, and then this is a projection to get us to the end? Okay. And what have we done that's doubled council, Board Council's costs?
Well, I'm not sure I can answer that question. I can say we probably do use board counsel a little more than we did in previous year, partly with the real estate items that we're dealing with. Additionally, I know in the past he had been capped by this previous employer as to the number of hours that he could work outside their system. So I don't know if Jeff has any comments on that.
So it is true that I was capped, and frankly, I was just not billing MSERA for work that I was doing. I was looking at the dollar amount when I divided it by my hourly rate. It's 400 hours a year, which equates to four days a month of billing. And 1 day is the meeting, so that's leaving 3 days of billing for the rest of the month. And I only do the work that's assigned to me, and I don't know how to answer it any other way than that.
It's not about it. I know that like the real estate stuff and some efforts during the evaluation period was above what we expected, but just thought I'd ask. Thank you.
Any further discussion? Judy, can we do a roll call vote?
Yes, we can. Mr. Land?
Aye.
Mr. Kelly?
Aye.
Ms. Cavanis?
Aye.
Mr. Jurdy?
Yes.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Ms. Pierce?
Aye.
Approved.
And so we'll move forward to item 7, administrative report.
The administrative report is in your packets, and it looks like we did not actually get the administrative report posted on the public website, Judy. So if you have any questions regarding the administrative report, I'm happy to entertain those. It does include the information on the upcoming SACRS Board of Directors election. Nomination period is open now through March 1st if you want to nominate anyone or yourself. There are also SACRS legislative updates in there for you. Today is the last day, if you have not already paid your premium for the waiver of recourse premium for our fiduciary insurance, to pay Judy your $10.
It went up.
Huh?
Oh.
And honestly, I don't recall what else was in the admin report. There was an update on pension gold that we're moving ahead with the separate accounts implementation, and that's expected to be delivered to our test environment in February. There was one other thing in there I wanted to touch on, but I don't remember what it is, and I can't access the report until I find the share site, so give me just a second. Oh, I'm sorry. Thank you so much. I wanted to give an update on the member status confirmation project that we undertook at the board's previous direction. During December, between December 5th and December 13th, staff sent out 135 confirmation notices to members who were ages 84 and over. We received 76 completed forms as of January 12th. That's a 57% response rate already. We did learn of the deaths of 2 members after the confirmation notice was sent, and the death of a member prior to the mailing of the notice. The deaths are not included in that table below in your board packet. The response has been good. It's likely attributed to the fact that we did courtesy calls to warn people that we would be sending them this form and what they needed to do with it to get us back to it. We do have alternate methods of confirmation available for people who are unable to secure services of a notary for whatever reason. And so far we've done through January 12th, 2 using an alternate method of verification. So the man hours were more than initially projected when we discussed this project. Again, in part because it was a new project, staff had a sort of a learning curve to get up to speed on that, and the fact that we did confirmation or courtesy calls in advance to let members know to expect this. The other item I wanted to bring to the board's attention was a recent California Court of Appeal decision for Ventura County Employee Retirement Association regarding exclusion of leave cash-out payments in excess of the amount permitted by an annual MOU. That court decision is not published, which means it only applies to Visera and cannot be cited as precedent by any other retirement systems. This decision is relevant to other serial systems because, like Visera, MSERA, and other systems similarly limit the amount of leave cash-out permitted to be included in compensation earnable to the amount permitted in the member's MOU. As such, counsel for Visera has asked other systems to send a letter to request the court publish the decision, and I will be joining several other pension systems in signing such a request.
Thank you. Next, we're going to have, there's general board member discussion, and after that, we'll go into closed session. Any discussion? Okay, seeing none, we'll go into closed session. First, there's a service-connected disability application from Alman, retired sheriff pursuant to Government Code 54957B, and B, conference with real property negotiator pursuant to Government Code Section 54956.8. Is there any public comment?
There is public comment.
And retired sheriff, I admire you all for sitting through a meeting like this, staying awake. I want you to know. I know it's important numbers. By golly, I appreciate the time you're giving to the county. So thank you very much for your consideration of my application. Thank you.
Thank you. Okay, we're going to go into closed session. reconvening after our closed session. And our counsel, Jeff Burke, is going to report out.
Thank you. So on item 9A, the service-connected disability retirement application for Tom Ullman, the board voted to approve that application with trustee Jurdy voting no. On item 9B, conference with real property negotiator, the board gave direction to staff.
Thank you very much.
Thank you. Also, the harassment training that we were going to,
So we do have harassment training. Which of the trustees are planning to stay?
Not today? I don't think Mr. Kelly, so you're only two out of potentially.
I'll do the training if you'd like me to proceed. If not, I would like to speak very briefly on one issue while we have the trustees and we have this on the agenda. Yes?
Is this the AB 506 thing?
The harassment, I don't know.
It's AB 1825, you mean? No. So what's your preference?
I have no preference.
I'm happy to do it for the two trustees. We don't have a quorum anymore, but I'm really frankly not concerned about it from a Brown Act perspective. It's just a training.
We have the room, you can do it for the ones who want to stay.
Okay, I'm happy to do it. I'll do it for the ones who want to stay. For those of you who are leaving, what I did want to talk about briefly is whether you want to kind of give some direction to staff to bring back a code of conduct policy. And the reason that I bring that up, you may recall the unfortunate incident that occurred allegedly, however you want to phrase it, in the town of Windsor not too many years ago involving the mayor. And I think that boards have been looking at what kinds of policies that you can put in place that require some appropriate code of conduct. And there are some CERL systems that do have a code of conduct policy that govern personal conduct and require trustees to conduct themselves and treat others with respect and professional courtesy and fairness and all those things. And we could bring that kind of a policy back to you. I do want to also mention that the enforcement provisions in those policies are fairly limited. You can make it so that if you feel that a trustee has acted in a certain way, they don't hold an officer position. You could censure them. If they're appointed by the Board of Supervisors, I suppose you could ask the board to remove them. But if it's an elected trustee, then you're very, very limited. I think San Francisco may be the only jurisdiction in the state that actually has a procedure in place to remove someone who's been elected by the voters at large. And I'm not sure that's ever been challenged, and I'm not recommending that here. I think because we're the retirement board and we're kind of one step removed even from the voters directly electing somebody. But I do think you could have a code of conduct policy, and I have discussed it with the executive director, and I don't know if you want to speak to this issue about whether you want to give some direction for us at some point later this year to bring back that kind of a policy.
I'll say that I don't think it's ever been an issue on this board of where I'm concerned about it, but I would rather have something and not need it than need it and not have it. That would be my 10 cents. And I get that there's not a whole lot of teeth included, especially with electeds, but it is very, it's a powerful thing even when you censure somebody that's in a position like that, and that could, I'm sure there's a recourse to those people that voted for that person to take action at that point. And not reinventing the wheel, I'm sure there's other policies out there we could use and make our own.
so
Generally thumbs up, you want to bring something back or no?
Yeah, there's no reason not to.
Okay. Thank you.
Thank you. So-
My question, we can't report out until that training is complete because it's part of the meeting agenda, right?
Report
I'm sorry,
out.
to do adjournment and notice of the next hearing for item 11.
Right.
Correct.
Yes, we'll adjourn when the training is completed.
So are you gonna have a quorum for the training?
No.
Then why not adjourn and we just get our certificate? I don't mean
Okay.
it that way. I mean, do the training for,
That's what I was suggesting. So you're saying do the training, then we'll adjourn?
no, adjourn.
Just adjourn now?
And the people that are
Okay.
gonna take the training are no longer a quorum, so they can just train.
Okay, I'm fine to do that. We can adjourn the meeting.
That's reasonable. Okay, the meeting is adjourned, and the next meeting will be Wednesday, February 21st at 8:30 a.m. Thank you.
So we gonna do it here? Or we
Yep.
gonna- Okay. And are you gonna use this screen here?
Will be interesting.
What? Oh, you
It'll be
bet.
interesting.
Thanks for.
So I'm gonna turn my
thanks
mic off.
in there. I'm looking forward to more than a couple breaths out of you.